Hello, everyone, and welcome to another episode of the Forever Cash Life Real Estate Podcast. Today, we're going to talk about the exciting subject, and it's really exciting, of self-directed IRAs and how you can save tons of taxes using this vehicle. Who doesn't want to save taxes, right? Let's get started in just a second.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
Okay, so we are back, and welcome to our guest, Dennis Blitz. Dennis Blitz from the IRA Club. Welcome to the show.
Wonderful. I'm happy to be here.
Right. Actually, Dennis is my favorite IRA guy. We have worked in the past, as you guys know, probably if this is not your first podcast, we do land flipping, but we also do syndications of apartment complexes. And we have worked with multiple IRA companies. And I have to say, IRA Club with Dennis is the easiest to work with, the most responsive, the one of the least expensive. Also, least the fees are the lowest, some of the lowest. None of them are expensive, but their fees are really one of the lowest. And we just love doing business with you guys. So I wanted to bring you on because I also love the level of expertise that you have. So first of all, tell us a little about it. How did you start up this company, and why? What is so exciting about IRAs for you that you want to make it your career, or that you've made your career for many years now?
Wonderful. You know, I will do very fast why we started the company. People ask that all the time. It's, I think, a particularly boring story, but I keep getting asked, so we'll do it quickly. I had worked my whole career in the publishing industry. I wrote textbooks. I wrote textbooks on security law, security regulation, and if anybody out there knows any security representatives, they took license testing, Series 6s, Series 7s, Series 3s, etc. I wrote textbooks for those courses, and you know, most of we had a pretty high market penetration, so a lot of people took our courses, and nobody ever read any of my books because they wanted to, only because they had to. So that was what I did. When I left that job, when I left that industry, I had been there a long time. I was a long-term employee. I was a highly compensated employee. I had a large 401k. And like other people, I was wondering what to do with my 401k. And I stumbled into reading about self-directed IRAs. I said, this is a great idea. Why doesn't everybody do it? When I went around to talk to people, this was many years ago, there was no one to talk to. So what I did was I ended up starting a club in Chicago of people who had self-directed IRAs. We would get together, we would talk about what we were doing, what we were investing in, how we were doing it. And pretty soon people wanted to start self-directed IRAs, you know, for their friends, family, etc. And I started doing that. And that was how it got the name IRA Club. I just saved the same name that we were using. And to be honest with you, not for any other reason than I already had the letterhead. And I wanted to save money on new letterhead. So that was how the name IRA Club came about. So that's the boring story. I won't bother you with anything more. But the thing I want to talk about with Jack's group is different than what I talk about with some other groups, because Jack's course, if you've ever taken it, and if you haven't taken it, please do so. I think it's one of the best 3-day sessions for real estate investing I have ever been to, and I've been to many, many of them. So I do recommend it. But Jack's course has a problem. And the problem is that they make a lot of money and they make it quickly. So nobody ever benefits, or very few people benefit from long-term capital gains. They're always paying ordinary income tax on these transactions. It's brutal. You know, every now and then I get to
one disadvantage of one and perhaps the only disadvantage of working in land, that if you flip land, even if you hold land, it's like there's no depreciation, there's no tax write-offs. It's just either ordinary income, or if you hold it, it's capital gains. But there's nothing in between. There's nothing to shield it. Which is one of the reasons why we do the apartment complexes, because they help us shield the income we do on the other side. But go ahead.
Exactly right. So what happens is, you know, you follow Jack's program, you make an investment. The investment has, let's say, an $80,000 profit. You're excited. You're calling your friends, family, relatives, the people you didn't like at work that so they get aggravated. You do all those things, and then April 15th comes. And it depends, if you live, what your tax bracket is. It depends on the state you live in. If you have a state that has state income tax, there are local income taxes now, etc. And so you could end up with a $34,000, $35,000, $36,000 tax bill on your $80,000 profit. It takes a lot of the wind out of you. You want to be able to think about the tax consequences. I mean, if you made just 3 investments in a year that made $50,000 a piece, you're going to end up with a $60,000 tax bill come next April. So there's a lot of taxes that get paid on these programs that Jack does. They're profitable, they're fast turns, they're everything the tax man likes. And so what we want to do is just take him out of the equation. Well, the tax code was written back in '74 to allow you to take him out of the equation. And instead of you making these investments, let your IRA make these investments. Just a very, very simple self-directed IRA would make the investment. The IRA then sells the investment. The IRA makes the profit. Because you never made the profit, the IRA did, you don't pay income tax. And IRAs don't file a tax return. So that whole $80,000, that whole $150,000, whatever it is, stays in the IRA for future growth. So the question becomes, is it worth it to do that? And just to give you some numbers, it is worth it to do it because to start a self-directed IRA costs $175. So the choice is, for many people, do I want to pay, $175 to set up a self-directed IRA, or do I want to pay $30,000 or $40,000 in income tax? So it's a pretty simple choice, and one that you want to consider as you launch into this career, as you're looking at a transaction that you think is going to be profitable.
Yeah, absolutely. So there's actually, I'm looking it up right now. There's actually somebody in our Facebook group, Land Profit Generator, Real Estate Investing Facebook group, that who had literally just posted something a few days ago. From Naveen is his name, where he posted a check that he made $36,000, and his check that he got back was for $48,000. So in other words, he invested $12,000. And he got $48,000 back. So if he does that, if you do that outside of your self-directed IRA, you made a $36,000 income. There is now nothing right off there. You didn't have to go in. You don't even have to have gas costs, right? You don't even have to go drive there. No hotel, no nothing, no rehab, something. You just bought it for $12,000, sold it for $48,000, made a $36,000 profit. So other than a few mailing costs, like $1,000 of expenses or so, plus closing costs, another $1,000 in expenses, which is already subtracted there. So he basically netted $35,000. Well, that means he's going to have to pay about $15,000 in taxes.
Yeah.
But most people have, if you have an IRA with your company, you can roll it over, right? You can
a 401k, yeah. If you have a 401k, yeah, right. And so we'll come to funding these accounts, but a lot of the ones that Jack does, you get in so small. We'll talk about funding it by rolling over IRAs, rolling over 401ks in a moment, but you could just start one because you can put in $6,500.
And that's enough
today,
to do a few deals, yes.
Which is enough to do deals. And this is, I don't know when you're going to be watching this, but we're recording this in December. If you open an account and put in $6,500, in a few weeks is January, you put in another $6,500, and suddenly
$13,000. That deal that I just talked about could be possible then already. Right.
That very good point. Yeah, very good, very good.
Yeah. So within basically by March, you fund it in December with 6,500. You fund it in January at 6,500. You do the deal like that in February. You sell it in March. By March, your account has grown from $13,000 to $48,000. Wouldn't that be a nice thing? Yes. Yeah.
So a tremendous number of people who work with Jack's program, will want to do that first deal outside the IRA, and they're proud and they're happy and they're excited and they're posting it on the internet, and then April 15th comes. So we do want to talk about, or you do want to think ahead a little bit about, how do I shelter all that income? And the IRA will do it for you. One of the things that people ask is there any kind of a deal that shouldn't be done in an IRA? And, I can tell you, I'm an IRA person, and you would expect me to say, no, everything should be in the IRA. Not really true. There are deals that shouldn't be that don't need to be in an IRA. First of all, they're ones that we kind of discourage. We discourage people who really need that money for next month's car payment, next month's rent payment,
Right.
and things like that. If you're not really ready to invest, you're ready just to make your daily costs. Don't do it in the IRA. And the other thing is, if it's really a tiny deal, if you say that it's a deal where you're going to make $1,000, $1,500, there's no need to bother with the IRA. The amounts are not big enough for you to distribute about the taxes.
Right.
But,
So that's actually brings me to a point. Is that only because of the taxes, or when I talk to tax professionals, they tell me always that if you do too many deals, and the definition of too many is a gray definition, if you do too many deals inside of your self-directed IRA, you might be subject to UBIT, unrelated business income tax. In other words, that the IRS basically says like, hey, you're getting a competitive advantage here. You're getting to run a business inside of your IRA, and you're saving the taxes. Therefore, you could potentially sell the products cheaper because you're not having to give us our piece, and that's not right. So we're going to slam you with actually disqualifying your entire IRA and charging you even more taxes on everything.
Right.
Where do you think is the limit for that?
Thank you so much for asking that question. That doesn't come up very often, and it takes a more astute person to bring it up. But I will tell you, the practical matter is this. I've been doing this now for 11 years. We've done thousands and thousands of accounts. We've never, ever had anybody questioned on UBIT. So much so that I got irritated. Where is this limit? Because as we know, as you said, the IRS won't tell you, well, this is the limit. 12 deals, 10 deals, 9 deals, 99 deals. They just won't give a number, and they want that latitude, and I understand that. So about 3 years ago or 4 years ago, my office is in downtown Chicago, as you know, and I'm only about 2 blocks from the federal courthouse. And I was reading something, and there was a case that was coming up in federal court here in Chicago about somebody who had done exactly what we're talking about. And he was going to go to tax court. So I figured, well, I would just walk over there 2 blocks away and, watch the argument. What was the IRS, claiming this terrible felon did? I didn't know who the person was. He wasn't using our company. But I'm sitting in the gallery, and what he had done was he had bought from a bank a tape. I think it was about 320 houses that were in foreclosure. They're all in a very, very tight neighborhood. And he then, his IRA bought them. He then set up an office, set up 800 numbers, hired a staff of canvassers to call out, and did all those other things that looked like a business, felt like a business, smelled like a business. 350 homes or 320 homes. The IRS said this was clearly a business. So the point is that when they go after this issue on UBIT, which is it's in there and you're precisely right, they're going after people that are obviously running a major business. It's just not worth it for them to go after the guy who did 3 deals or 4 deals, and
Right.
it's a practical matter. Most people are at that level.
So the number I've heard, that it makes perfect sense. Now, having said that, our people do businesses, so it's just that they don't have a bunch of staff. It's like them, their spouse, a virtual assistant, and that's it.
Yeah.
But many of them do it full time. Like we have liberated hundreds of people from their jobs. We don't know the exact number, but we have liberated a lot of people from their jobs, and they're doing this full time now. And so with that said, what I always hear is that you should be doing the majority of your deals outside of the IRA in your business, but then perhaps a few deals in there. And what I always say is like, how about you do your best deals inside of the IRA? If you have a deal that you know that you're going to pick up for 12 and it's worth $100,000, then move that thing into the IRA so that you get that $36,000 profit in the IRA. You do that 5 times a year, but out of your 50 deals now, it's only 5 a year that you do there. And I don't know if 5 is the right number. Perhaps 3 is the right number, or 7, who knows? But you do 3 to 5, your 3, 4 best deals in there. but the majority you do outside. And then kind of like you can make the case of, or perhaps you even do some buy and hold deals in your IRA, so that it's like a combination of buy and holds, and that you just buy and you hold them for a year or two, and then you sell them for 10 times your money. And so it becomes a combination of like, I'm doing my active business here and I'm putting my passive business over there. And every once in a while I just sell one, and sometimes I sell them quickly, but sometimes I sell them slowly. Is that the strategy you would condone?
Could not agree with that strategy more. That's a wonderful strategy. I have, again, never seen anybody who uses a strategy even that's not even that carefully thought through. I've never seen anybody bothered by that, by the IRS. Again, the ones I've seen bothered by the IRS are people who are really, 350 homes, 320 homes, pretty major situations.
So major. I mean, 220 homes, even at the downturn when they were $50,000 a home, that's still 55. That's still $10 million or $15 million that you buy, and then you hire staff and then to sell those businesses, those deals exclusively. So really 99% of your business is inside the IRA, and then you're obviously violating the rules.
Yeah.
But if like 80% of your business is outside the IRA rule, or 90 or whatever the number is, don't trust me. Just go look at follow your own advisors and counsel on that. But then you should be safe. You're saying, okay, good.
I absolutely. So let's talk about. Let's see what I want to talk about next. Oh
no, actually, I want to ask you something. So here's the thing. Is there any rule? So particularly when we're dealing with apartment complexes, we have multiple investors right now. We are raising. We're almost pretty much done raising, or by the time this is published, we already own another 158 units, apartment units, and we probably had 10 investors invest from the self-directed IRA. Every single IRA company has their own documents and their own process on how to do that. Is there any kind of guideline of how that needs to be done? Or let me ask you the other way around. Typically, when an investor buys something through their IRA, who signs the paperwork?
Oh, for sure. If the IRA is the buyer, the IRA is the signer.
Okay.
Because
now, typically though, if that is like a bunch of paperwork, where is the limit between what the IRA person does and what the actual investor does? So like, can the investor typically fill out these forms themselves and then the IRA just signs it? Is that how expected because he knows all about the deal? Or it seems like every company does it a little different. So I would like to know from an expert how this all works.
Well, that's a very interesting point because I'm actually involved in that in another situation right now. The reason that they're all different is because the IRS rule is not clear. The IRS, the IRS when they were writing this rule did not take into account real estate, did not take into account syndications. They thought everybody was going to buy stocks, bonds, mutual funds. And so that's really what the rules are written for. So when we get to the alternative investments, which by the way, you need to know there's well over in our association, there's well over $150 billion in self-directed IRAs. It's not, it's not some, fringe item. When it comes to something that's not a stock bond mutual fund, a lot of it is up to that IRA company, basically their legal counsel, that says, let's have this in our files so that it's very clear who owns what, who decided what. In our particular case, we do as much as we possibly can for the client. But even that, we do want the client to sign off and say, yes, this is what I want. This is the investment that I want. This is how much you want to pay.
Right. So typically what's involved, and again, a lot of our investors are beginning investors here, and a lot of our listeners are somewhat more beginning investors. So when you when somebody sets your own self-directed IRA, they contact you, they set up an account. There's a few forms they need to fill out. They transfer the money from their former employer or they fund it with the amount that they are legally allowed to fund it, and now they're ready to go. So now they find an investment that they want to do. What's the process? Can you walk us through the process that they need to do?
Thank you. That is so very simple to do. Once the account is open and it's been funded, and as Jack says, it's funded because it was either a transfer in, and people transfer in from existing IRAs. We're moving money from Fidelity, from Charles Schwab, from those companies, literally every day. And we have, we're on the phone with these guys every day, so they know us, we know them. It's a very simple transfer. or they're transferring from a 401k, same thing, we'll do all the paperwork for them, or it's a contribution. So once the funds are in the account and you're getting ready to make the investment, we say, look, on your first one, and I can tell you can do everything online, but on your first 1, 2, 3, 4, whenever you're comfortable, transactions, we want you to call us. We want you to say, this is what I want to do. I'm going to buy this house here. I'm going to buy this syndication there. I'm going to buy this piece of real estate here. And we'll say, okay, let's do it together. We want this and this and this. And what we want is basically, because we consider ourselves to be the buyer on your behalf, for benefit of. What we want is really the things that you should be asking for. Did you ask for the offering document? Did you ask for, if it's a house, a purchase agreement? Did you ask for those things? And so we pull those things in, and when the file is, says, hey, everything is here, and we're talking to you every day on this stuff, we'll say, let's proceed with the investment. And, now you tell us that you want us to release the money. And we send you this little one-page form called investment direction. In other words, you're directing your IRA to make this investment. And then we will, complete the investment. We don't approve an investment. People get confused about that. We don't approve an investment because you've decided that. The client makes a decision to make the investment. We want to make sure that the client has their paperwork in order, and we'll walk them through it. This is what it should look like. This is what's there. And then we have a nice complete file.
Wonderful. That makes sense. So it's not scary. It's once it's set up, it's actually a simple process. And what I heard you say is, like, just to reiterate one more, you guys are what's called the custodian. You're not an investment advisor. So can you talk about that one more time? When you call us, we will never ever, we don't sell or offer opportunities, and because that's a whole different industry. It's a whole different, situation. If you think of us as a bank, you're about right. Because as a matter of fact, we're regulated under the Banking Commission. Because what you think about what we do, you bring your money in, we hold it, and we'll pay you we do pay money market rate interest on it, which is not very exciting, but we do pay money market rate interest. And then when you say, no, I now want to make this investment, we say, okay, how much is it? We send it out, but we take in the asset. So the asset is in the name of your IRA, not in your name. And one of the things where we seem to get involved more than I thought we would is exactly that, with titling the asset. We'll call especially if there's a title company involved. We like it when there's a title company involved because they're going to dot the I's and cross the T's. But title companies really want to hear from us because we're going to say, don't forget, Fred is not buying this property. Fred's IRA is buying the property. Here's how to title it. And that's what title companies want. They want titling instructions. Right. Yes. And often they don't know. That's actually a question I get in our syndications. I was like, well, what do I put up there? It's like, you got to ask your custodian because they will tell you exactly how it should be named. And yesterday.
We'll give it a name, including your account number. I mean, your account number will be on there. It'll say, your name, account number 2345.
All right, wonderful. Exactly. That's how it typically looks. Great. So that's good. So now let's go back just one more time to the simple basics. So in essence, what people understand, what they set up is an account, just like they have in their job, a 401k. You can also set up IRAs. You can set up Roth IRAs. You can set up all these advanced kind of like whatever they're called, like
SEP IRAs, simples and SEP, and any IRA can be self-directed. And it really, for us, I don't want to make a big deal out of it. It's really just changing the form,
Okay. Yeah, absolutely. So then once they're set up, it's almost like there's an entity that belongs to you, but that is outside, and that in order to keep things clean, you cannot sign for.
Right.
That's how I think about it. That's how I explain it to people. So therefore, you make the decisions, but you, Dennis, and your team sign the forms based on the instructions that your clients give you.
In other words, the client does everything that's important. They decide what they're going to invest in. They decide when to buy, when to sell, what to pay, what to sell it for. All the important decisions are the clients. What we're doing is keeping it IRS compliant.
Exactly. So you're signing the things, you're making the money comes out of the account with you to purchase, and then it goes back in the account with you. So it's compliant. It's out of the reach of the investors. They can't go pay their grocery bills with it. And it's like it was with Charles Schwab or Vanguard or this, where you couldn't touch it anyway. Now it just sits with the IRA Club. Right. But you guys using the loophole that says that really that with in your IRA, you can only own everything really, except for, I think, speculative pieces like art and certain kinds of gold and things like that, right?
No collectibles. And we'll take a minute here, but that is not in the original act. But you cannot have collectibles in your IRA. So I'll tell you a short story. Collectibles, you could have any investment for your future, was what the original act says. By the way, it still says that. For your, can be in your IRA, any investment for your future. So that was back in '74. Well, guess what? There's always people who are nefarious, and there were some guys out in California selling to people with an IRA fine wine, cases of fine wine, because wine never goes down in value. Well, anytime somebody says it never goes down in value, it's time to get up and go the other way, because things change. And the IRS got very irritated with it because how do you value fine wine? And then they got really irritated when they opened the bottle and found out it was grape juice. So and the whole thing was a fraud. So the IRS originally, back in '86, was putting into the code no fine wines, and then realized, wait a minute, we can't value any collectible. Whether it's sports memorabilia, because the people had sports memorabilia, people had all types of things in there, antique guns, God knows what, because they thought it had value. Now, here's my personal story. My personal story is I happen to like classic cars. I have loved classic cars forever. I go to classic car auctions, la-da-da.
Got to come out to Phoenix in January. We have a great auction.
You have a wonderful one. I'd love to come to that one. So I've had a couple classics. And one day a guy calls up here and he opens the account. This is several years ago. And in the account, in the list of assets, is I think it's a 1939 Duesenberg. It is, and there's a picture of it, and it's stunning, and it's perfect, and it's a wonderful car, and something that I have lusted for. So I have to call him up and say to him, when did the Duesenberg get into your IRA? Well, of course, he gave me a date before 1986. He's grandfathered in. It's just fine. And once a year, I still to this day call him. He's way deep into his 90s. And I say to him, Jack, how is the Duesenberg? How are you feeling, Jack? And how is the Duesenberg? And he says, it's in the garage. I don't take it out much anymore. And I always say to him, that's good. Don't take it out. You got to be very careful with those. And I said, how are you feeling, Jack? And he says, fine. And I go, damn, because I'm waiting for that guy to pass away, because I know I've talked to the kids. They don't want the damn Duesenberg. I would love it. So, there is that one collectible hanging out there that I'm watching. That was a morbid story, but it's what I'm doing.
All right, so let's not go deeper into that one.
One of the things I do want to, but you know what I want to talk about that we do so much of it, we're seeing more and more of, is something that you talk about in your classes, and that is selling, with seller financing. And IRAs are wonderful at that, because IRAs are very, very patient. So, and you can talk about for a moment, the two benefits of selling with seller financing, which from my point of view are, one, you're generally able to sell it for a higher price because, the person kind of gets in less. They're more concerned about the downstroke than they are about the total number. And two, you're making interest on, those payments over a period of time. When that happens in your IRA, it just really, really increases the income potential of that IRA. And again, all that, not only the profit from the sale of the land, but the interest is all tax-free.
Right. Well, tax-free or tax-deferred?
Well, I'm glad you said that. I say tax-free too much, and tax-deferred is right if it's a traditional IRA. If it's a Roth IRA, it's tax-free. And on these accounts, I do suggest that people consider the Roth. the Roth does have the problem of that one little tiny prick of a problem at the beginning where you do have to, you don't get the deduction on the contribution, or if you're bringing in a transfer, I should say, you do have to pay the income tax on the value of the transfer. But then all the income for the rest of your life is tax-free, and not only for the rest of your life, but the rest of your heirs' life. Because remember, if you should pass away and there's still assets, so the money is still in that IRA, you're not leaving them money. You're leaving them the IRA. And so if they inherited a Roth IRA that has $1 million in it, you just gave them $1 million tax-free. If you gave them a traditional IRA with $1 million in it, you gave them a big tax bill.
Right, and that's particularly the beautiful thing. That's why, particularly for land flipping, I actually am a big fan of Roth IRAs. Because if you fund that thing with after-tax dollars of $5,000, and let's say that's after-tax $7,000 or $8,000, you pay taxes, you have $5,000 in it, and you use that, and you do that, like just we talked about earlier, and you grow that to like over a couple with like a deal that you buy for $2,000, sell for $8,000, then you do that a few times, and now you have enough money, and then now you do that $12,000 deal, you make 48 out of it. Now, that same growth, you're not growing in much slower than the other one. It's the same thing, except that on a very small amount of money up front, you pay taxes, and then you use that small amount. So you end up paying $2,000 in taxes or so, and then you go use that and propel that into hundreds of thousands of dollars over a few years, perhaps even millions of dollars over a bunch of years, like we have done, like other students are doing right now. All of a sudden, all that money is truly tax-free, and particularly for the ones that are older. I know we have a few students that do this. Like again, they keep the ratio and so on that that we talked about earlier, somewhat of a ratio. But one of our students is like in the 60s, and so he does all his best deals in his self-directed Roth IRA. And the moment after the profits comes in, let's say a $25,000 profit comes in, he takes the money out, and it's tax-free.
That's exactly right. Once you're over 59 and a half and you've had that IRA you've had a Roth IRA for more than 5 years, just take it out tomorrow. Right. Or take it out today, because that money is 100% yours, and just do it in the Roth IRA. But again, you have to have the Roth IRA open for 5 years. They don't want you to open the Roth IRA on Wednesday and taking it out on Thursday.
Sure, absolutely. That makes sense. All right. So great. So is there any other subject you want to talk about?
Yes, there is. I want to talk about two things. One is people comment all the time, gee, the money's tied up. I want to talk about money being tied up. It's not really tied up. If you have an IRA, people say, well, it should be there till I'm 59 and a half, et cetera. If you're over 59 and a half, you don't worry about it. But if you're under 59 and a half, you might. Here's the thing. It's not tied up. If you have money in an IRA and you want it tomorrow, we'll send it to you tomorrow. There's no rule that says we have to hold it. We'll send it to you, do what you want to do. You've always wanted to buy the new Corvette, knock yourself out. However, the IRS gives you all these tax benefits of tax deferral or tax-free because you, in essence, have promised them, I'm saving for my future. And they just had to pick a number, and they themselves admit it was just a guess of a number. They used 59 and a half. That's your future. And so they said, if you leave it until you're 59 and a half, you get, there's no penalty. If you take the money out before 59 and a half, well, wait, you kind of misled us. You weren't saving it for your retirement. You weren't saving it for your future. And so there's a penalty, and it's 10%. Now, it's kind of like cashing in a bank CD early. And every now and then people have a need for the money, and they need the money, and they say, well, the 10% penalty isn't all that bad, and they pay it, and they can have their money. So the money is always there. It's always available. 10% penalty, but the penalty, even that goes away at age 59 and a half. The last thing I do want to talk about is the cost of these things at $175. And I want to do a special just for this podcast. And that is, if anybody contacts our office after watching this podcast and asks for Kasia, Kasia, Kasia's a very nice person. Kasia will talk to you, and just tell her the promo code Jack, and we will knock off the startup fee. The startup fee is $40, and so it'll be not the $175, but $135 to get yourself started. So there we are. I think we've covered the topics.
Wonderful. So actually, along those lines, I wanted to ask something. Just one quick question. So, and I forgot it right now. Whatever it was, it'll come to me again. What was the thing you just said right before this?
I just said what
Oh
a
yeah, the
wonderful person
taxes.
Jack
The
is.
taxes. Yes, yes, yes.
Yeah.
So how does the IRS look at borrowing from your IRA?
If you're going to borrow from your IRA, we would strongly discourage it. The IRS doesn't like that, and when the person calls us up and says, and it happens all the time, especially with rookies, because they'll put X dollars in their IRA and they say, now I want to make this investment. Let me borrow the money out of the IRA, and we say, okay, slow down. You're not going to borrow any money from the IRA. Let the IRA make the investment. And let the IRA own the investment, and let the IRA get all the tax, and then that's where all the tax benefits are. If you're going to borrow from an IRA, there is a back door. We don't recommend it, and that is the IRS will completely look the other way. No penalties, no nothing if you get it back in within 60 days. It's just a back door. It's not worth it. And if you want money from your IRA, just call us up. We'll send it to you. There'll be 10% penalty if you're not 59.5, but we'll send it to you the next day.
All right. Okay. Wonderful. That's good. So good. A couple of final questions. I see books in the background. What is your favorite book that you have been reading lately that our audience might also enjoy?
Well, my favorite book that I've been reading lately is what I've been writing lately, and you're in it, by the way.
Right.
And I don't think my name, but your topic is, and the book is called 15 Things You Can Do to Make Money with Your IRA and Old 401k, and that book is coming out in April.
Wonderful. Looking forward to that. And then do you have any kind of like a daily routine that keeps you in line towards continued success?
I would love to say something really brilliant and insightful that people carry away, but the fact of the matter is, ever since I've gotten involved with this topic, I have been having so much fun. I've met wonderful people, but I've learned something new every couple of days. As just with your business, Jack, every deal is a new experience. Every deal has some little twist to it that it gives you information you didn't have before, and you say, gee, I can use that in the future. And that constant learning opportunity and that constant experience has really gets me motivated and really gets me excited, and I jump out of bed to come to work every morning.
That is wonderful. All right, so that's about the best way you can be, actually, right? Anyway, so great. So with that, again, give us the link. I mentioned already. It's the IRAclub.org, right?
.org. Yep.
So IRAclub.org. So there's no the up front. It's just IRAclub.org. We're obviously going to put in the show notes into the comments. Again, as I mentioned at the beginning, we have been working with a lot of different IRA companies. This is the one that I moved yours is the one that I moved my own IRA much. I don't do much in the IRA. I should do much more. But at the beginning, our problem was that we were broke. And just like you said, if it's your first deal, don't necessarily put it right in the IRA if you need to pay. Don't ever put it in the IRA if you need to pay your groceries with it the next day. So we needed to get out of debt. We needed to get out of, and we wanted to also use the fruit of our other investors, the cash flow for it. So we did a lot of things outside of the IRA, but we are starting now to put a bunch more in the IRA because all of our cash flow needs and other things are obviously taken care of. And so the other part that we're doing now is really just for tax prevention and for tax shielding. So for that, an IRA is an absolute wonderful situation. That's why I even said earlier, do some of your deals outside, put some of your best ones inside, so that this grows while here is enough money left over to pay for your lifestyle and upgrade your lifestyle and live the life that you want to live. But again, so we chose, of the ones that we work with, we chose IRA Club for our own IRA, and I recommend everyone, you guys go and contact Kasia. Contact Dennis, and they're great to work with.
Well, thank you very much. But I can clarify that. Contact Kasia. She's much nicer.
Okay, right. Plus, you're probably spread thin all day. You're going to event after event. So contact Kasia. With that said, and we'll get her contact information again, and we'll put it on there too. So
Terrific.
With that said, thank you very much. It was a pleasure having you on the show.
I enjoyed it. Let's do it again.
Wonderful. So with that said, thank you very much, everyone. This concludes the next episode of the Forever Cash Life Real Estate Podcast. Make sure you give us 5 stars on iTunes. Go put a review on there. It helps us reach more people. If you're watching this on YouTube or any other or on Facebook, if you post it there, just give us a thumbs up. Share it with your friends and your family so we can reach more people. With that, thank you very much. Bye-bye.
Thank you.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.